Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
Good evening, everyone. Welcome to another episode of the Weekly Notebook Review. It is Wednesday evening, September 20th. It is a little after 8 p.m. here on the East Coast. It is a gorgeous, clear night outside of my Stanford hotel window. A little bit of a crescent moon out there, which my daughter loves to call a banana moon. But we are not here for the phases of the moon. We are here to talk about everything basically but the FOMC. No, just kidding. We'll talk about the FOMC and the Fed and Jeremy's decision. But really, we're going to obviously stick with our roots here. And as many of you know who are longtime listeners, and for those that are new to the program, the Weekly Notebook Review was started by myself and a few other Hedgeye subscribers. And we really kind of had this Wednesday night as kind of a look through, right? So we were reviewing the notebook, the portfolio, the signals from our weekend work over the weekend, and kind of how things have shifted and changed midweek, and then how are we going to position our portfolios and either adjust or shift things going into the back half of the week, next month, next quarter, et cetera, just depending on the time frame and time horizon in which we execute within our own process. So this This conversation is really for Hedgeye Nation. I consider myself still a proud member of Hedgeye Nation, although I am in-house now. But we are here to kind of help. And this the notebook review is always a lot more fun, a lot more engaging when folks out in the crowd, jump up and ask questions or share their own comments in terms of things that they're saying, seeing, and that kind of thing. But with that, why don't we kind of dive into it? And we'll get right into it. So obviously the big conversation and pretty much what you're seeing everywhere on FinTwit today is all about the Fed meeting, the FOMC. I think, Coach Keith summed it up pretty perfectly on this morning in his top three things in regards to, a lot of the bond market was pricing in, basically Fed rate cuts and was kind of looking past this FOMC meeting. We really kind of had that. I mean, the bond market, did move obviously in terms of post the meeting, but we're kind of looking at right now we're looking at the 2-year around 5.172. So that is kind of active trading. It closed the day. It was up about 1.65%. So closed kind of right around this level. It was 5.178. So obviously big move intraday, but we were kind of pushing right to the top end of the risk range. I suspect you're going to see another day in the 2-year in the risk range, putting in that higher low and a higher high, which makes a lot of sense since the top end of the risk range was 5.11 this morning. I suspect we're probably from a math standpoint from the VASP, we're still relatively close to the top end of the risk range. So if you're short rates out there or short bonds, I guess, anything with TLT, et cetera, that could be a good opportunity to sort of trim some, right? So depending on your sizing, and sizing is crucial, sizing and timing, this could be a good opportunity or potential opportunity to sort of, trim some back, right? So, basically we remain in the higher for longer camp. Certainly the, kind of global markets, or certainly on the U.S. side of things, are starting to price that in as well. And that was really kind of, I don't know if the equity market just sort of got a bit of a flush there, or realization that this is, that Powell is for real, and that, to quote Danielle, that he's grown a pair. But at the same time, it really doesn't matter kind of what I think, what you think, what we all think the market's thinking. It's really about what it's doing and doing what it's doing. And for right now, these rates, across the board. So 10-year, 30-year, 10-year, 2-year, all bullish trend. And the 2-year in particular, making higher highs. The 10-year made a higher high on a day-over-day basis. and the 30-year has been making higher highs and higher lows. It was kind of flat day over day coming into this morning. So again, I suspect that you're going to see those risk ranges all move to the upside. And that makes perfect sense given the moves that we saw today, kind of post presser and that kind of thing. That move index, interestingly enough, because we are price, volume, and volatility, that move index is down to 97. So it is kind of the first time we've seen it under the 100 handle since basically February of 23. So it's been quite a while since we've seen it at that level, and we all know kind of what happened afterwards. We saw a financial or banking, kind of a quasi-banking crisis. It was contained pretty quickly, but that is when a lot of the regional banks kind of blew up. I don't think I need to remind you what happened in March, but we quickly moved. Not saying that we're going to move from 97 to 200 again, but just something to be cognizant about, and that the volatility is coming down. So I mean, that is generally a good thing for bonds. And if you go back to the kind of 2018, 2019 range, when we kind of had a similar-ish setup in regards to kind of some quad 3, quad 4 environments, bonds and gold certainly outperformed. So, just kind of paying attention to what the volatility is doing, what the price action is doing, but obviously from this point in time on today, and over probably the next few weeks, I'd be looking at those risk ranges, right, and looking for, if you're looking to get long of the longer duration or something like that, or you think it's going to start to price in recessionary environment, then you're going to want to see kind of some consistent lower highs, and then some lower lows as well. So you're going to want to see that kind of lower high price action happening in the risk range, and that can give you a bit of an indication. And then obviously, once it does flip to a bearish trend signal or certainly neutral, then that's when you can basically the VASP is agreeing with what your, I guess, opportunistic ideal outcome is, which is being long, potentially long bonds and that kind of thing. But the other component here is obviously the in terms of U.S. equities here, the S&P, the NASDAQ, the Russell, they are all bearish trend and remain bearish trend. They also were putting in lower lows and lower highs this morning coming into the day, and they've been doing that for the last couple of days. But basically, and then the refresh range on the S&P was a big lower low at 44.01 versus where we saw it this morning coming into the day at 44.16. Sorry, 44.01 was refresh. 44.16 is where it was based on closing price, volume, volatility yesterday. And then that top end came down to 45.01 versus 45.03. So big lower low and a lower high. That is bearish. That's pretty much as bearish as it gets. And the only kind of, I guess, downside, now granted it's a little skewed at the moment just because of the massive spike of volume that we got on Friday, a couple of days ago, aka OPEX day. And so you're seeing volume. So I track it on a 5-day average volume at time basis. And the last 3 days, you've seen basically volume around the 80% level versus the last 5 days. But that volume on Friday was a plus 182% volume spike. So that's definitely skewing the numbers a bit. So I'd say, it'll be interesting. The volume, if you look this morning in terms of the stat pack that you get within the macro show deck, that volume coming in on the prior day was basically flat, and then the 1 month was down 2%, 3 month down 5%. So keep an eye on that volume statistic and what we share in the morning, because that's going to be telling in terms of volume kind of was increasing on a 1 month average. Then this was there's basically more conviction behind that. Just it's kind of what you can read through. So lower lows, lower highs on volume, and volatility was also increasing in regards to where it closed up at 15.13, which was up over 7% on the day. So big volume, big VIX spike day, and really the highest kind of level we've seen it since closing prices of basically 1440 on September 7th. And then last time we were kind of up here was back in late August 28th. We closed at 15.08. So it's been a while since we've been kind of at this level. And again, in terms of the VIX risk range, you want to track that. This morning you put in actually a lower low and a lower high, which is where in Keith's top three things, he talked about kind of volatility and, basically volatility was telling you that a lot of the positions were already baked on, like were already put on and were already kind of, the cake was baked ahead of the FOMC. What we're seeing kind of post FOMC meeting is maybe not quite as, the cake maybe not quite as baked. So if your mom or dad or whomever, grandma, grandpa, taught you how to bake cakes. For my mom, she always told us to put a little toothpick in there, a wooden toothpick. If it came out clean, then the cake was ready. I think this toothpick was pretty gooey this afternoon. So just keep an eye on that VIX risk range. It's currently neutral on the board, and if you start seeing those put in sort of higher lows and higher highs again, that currently 13.09 to 16.30. If you start seeing those again put in kind of 1640, 1650, and then that lower end start to creep higher, the probability is increasing that you're sort of even on a pullback day, those are days that you're going to want to kind of fade, right? So basically non-trending, episodic, down, up days in the S&P, down days in volatility. And those are prime opportunities to kind of fade the market and take the other side of the position. Lastly, just wanted to touch base on oil and kind of energy. So again, the crude oil itself put in a nice higher low today, but a bit of a lower high at the same time. So just more of a consolidation range. That crude oil has been putting in basically higher highs almost every day for a while, and you can see that in the price action where from end of June we've gone from call it 70 to 90 here, this or pretty close to it, 89.17 here this evening. And so just be conscientious of that, right? You've got about 4% again depending on the risk range tomorrow, but based on the closing prices today and this morning's risk range, you have about a 4% downside and about 2.5% upside. So again, just kind of like be patient there. If you have been long of energy alongside us, Keith was adding to UGA, I believe it was, UGA, and we're long XOP in real time alerts, right? So he's definitely in the camp. We're in the camp that this energy move continues to have legs, especially with the fact that Powell is disregarding the recent data that's coming in, and in particular, it's pretty much glaring in the face in terms of the two largest components of CPI are owner's equivalent rent and really energy, aka oil pricing. So to see oil move again from basically, what is that? That's like a 20% move from 7 no more than that. What is that? Yeah, almost 30, 27.75%, basically from call it 70 to like 89 and change here. So this is a massive move in the price of oil in the last, call it 80 days. And that's just, if you're not tracking that or not planning to try to fight that, and you've got 2%, inflation target, pretty hard to get to that, in our opinion, without trying to raise rates further. So, just keep track of that energy trade. You may get to, a good opportunity to buy at the low end of the risk range. He said this in, I think the UGA RTA actually, is that, it's whenever you kind of don't think you're going to get something at the low end of the range and you try to lose some patience, it's often when you get it. And that's when you got to take advantage of those opportunities. And energy and UGA, certainly, UGA, XOP are certainly right there. The other component that I do think is certainly worth calling out is gold, right? On the macro show yesterday, I believe it was, Keith mentioned that if you don't have a minimum size position on gold, that it would be a good time to get there. And that's where we're at the moment. We are still long on gold, but it is a minimum size position. We are no longer long of silver. So I know it's been kind of 2 weeks since we've been on. We had a great session in Vegas, kind of a live local session there in terms of the weekly notebook review last week on Thursday morning. But basically, no, it was Wednesday morning. But in terms of gold itself, I think, just the gold volatility continues to really play favorably in terms of it's down at, basically 11, sub 11, and it's up a little bit, week over week. I think it made a low, what was that, around 10.22. But again, pretty suppressed from a volatility standpoint. And gold itself kind of just been trading a little bit sideways here, certainly for the last, kind of since the end of July, or early August timeframe. So it's certainly picking up some steam. It had some positive price action kind of today, Wednesday, but we're now trading in futures in after hours markets at the moment, and it's down 90 basis points. But it had a good kind of update today in general, and what it closed at 1967. So that was above the top end of the risk range, which coming into today was 1959. So that was a higher high, and that's what you kind of want to see. You want to see things, probably the top end of the range, moving the top end of the risk range higher, bringing that lower end of the risk range up with it, volatility decreasing. Those are really attractive places to be. Again, we're only at minimum size position at the moment, but it's certainly an area that I think if it continues to act well and perform well, and price kind of starts to move higher, being confirmed, it's bullish trade and trend, continue to confirm its bullish trade and trend component, then it's certainly one that we're likely going to be looking to add back. So that's kind of what I'm seeing at the moment. I think the other big call out is a lot of kind of lower lows, lower highs on the board. You got Netflix, which is bearish trend, lower low and a lower high this morning. On NVIDIA, bullish trend, lower low, lower high. You've got XLK, a lower high, XLE, although bullish trend, a lower low and a lower high. Again, is that something to be conscientious about? This week notebook review is all about calling out on the signals, right? So coming into the week, energy, XOP, XLE, are all looking really good. Probably some of the best signal strengths on the board for the last few weeks, to say the least. So, XOP in particular, depending on when you got in, it's certainly one where you could be up anywhere from 10, 12, 15, 18%, 20%. Just depends on when you kind of added onto it in sort of June, July timeframe, or added to it, in June, July timeframe. XLE, kind of similar situation. Uranium, another similar situation. If you kind of added it, it's one of been a core long of ours in terms of the energy complex. You add it down in the kind of 20 range, you're up, about 30% or so, even on this, kind of 2-day pullback here. So it's been a really good place to be. But again, just calling out signals here, XLE putting in the lower low and a lower high. XLU, interestingly enough, just consolidating on the range in terms of a higher low and a lower high. But the other big call out, I think that again, if you're not paying attention to the out bucket on that risk range product, it's really crucial, because it's got 2, 4, 6, 8 different tickers in there, and everything from XRE to GDX, PINK, ITA, et cetera, and not a single one of those is actually bullish trend. So you've got six bearish trends and 2 neutrals. So again, be paying attention to that, because what I'm seeing is a lot of kind of the U.S. equities complex in particular, kind of losing signal strength, and even the bullish components, like something like energy or NVIDIA, it's they're either consolidating or putting a little bit of getting a little bit of price exhaustion, right? Which is very common. You get a little bit of price exhaustion, you get a consolidation of the range, and then it sort of decides which way it wants to go, either regain and gain momentum to the upside, or you might get some further kind of price weakness. And that's when you want to kind of, it'll break trade and then trend, and you'll get out. But so those are a couple big call outs here. I think the other interesting thing, on gold, which I forgot to mention, is that it came into the day with a plus 64% eyeball premium, and that's a plus 3.2 times on a trailing 12-month Z-score basis. So that's a big time premium on the board. So again, a big call out. And as I said, if you haven't built kind of a minimum size position in gold at this point in time, I think that is a potentially a good place to put some exposure. USO also had a pretty large premium at plus 70% eyeball premium and a plus 3.1 times on a Z-score. So again, anybody who's looking at that eyeball table, the Z-score of, call it plus or minus 2 is certainly something to be circling. I typically look at kind of plus or minus 1.5 and kind of pay attention to what's going on there. There's a lot of kind of, I would say nothingness, but sort of, not a whole lot. There's only 1, 2, 3, 4, 4-ish kind of exposures that on that sheet that really had kind of a outside Z-score, and Google and Microsoft were the other two. So just kind of something to call out. Again, we do like, Google is bullish trend, and we certainly do, and Freebird likes the Goog as well, or the Google. But if anybody's got any questions, commentary, I know I just kind of ran through a big gamut there, and but happy to take some questions. If you've got any, just questions generally. I will quickly mention Vegas in terms of the Hedgeye regional event that we had last week. It was absolutely a great session. It's these regional events are one-day events. Some folks do come in kind of the night before, and we kind of have a bit of a impromptu kind of happy hour type thing. But then we do the day of the event. It's the sector heads. Well, sorry, there's a lot, kind of a live macro show presented by Keith for only those people in the room, and then it goes into some like Q&A, and sector heads present pretty much for the rest of the day, and then it finishes off with another kind of Q&A session with Keith and the rest of the team, and then moves on to kind of a happy hour and dinners after that. So it's a really great event. We met some wonderful people, both professional investment advisors as well as individual kind of subscribers and clients of Hedgeye. It was great to kind of see everybody again. Those events always kind of reinvigorate us here at Hedgeye, and we're happy to recently announce Chicago as our next venue, our next Hedgeye regional on November 9th. So hopefully anybody in the kind of Midwest area or anybody else who wants to fly in, it should be a really great session. Good time to get together. And then the other component, this is not a Hedgeye conference, but David Salem and I are in Charlotte on October 4th for a conference put on by the Markets Group. It's their private wealth forum. So excited to get back down to the Carolinas and see some folks down there. I'm just kind of finalizing details. So I know a few of you have sent in your interest to kind of attend the kind of meet and greet session that evening in Charlotte. We will get back to you and let you know about the details. Kind of in the final process of getting that accomplished, but it's going to be that evening, October 4th. So again, if you're in the general Charlotte area, whether you're in North Carolina, South Carolina, you want to make a drive up from Atlanta, whatever you want to do, we're going to be there for a kind of a happy hour meet and greet on the 4th after the conference, probably from like 5:30 to 7:30 ish. It's going to be in South Charlotte. So I'll just kind of send that note around to many of our subscribers in the area. I was given a list of those yesterday. So we'll kind of get that on the books, but looking forward to seeing many of you in the Carolinas. Charlotte is where I grew up, so it'll be fun to get back there. Fun fact, my sister still lives there. I think we're going to host a happy hour at their golf club, which will be great. Awesome. So we see you on the board. A lot of friendly faces. I'm not going to force anybody to jump up, but this is a great time to chat. Sorry. The other thing too, from the Hedgeye front, it is all access week. So if you're a subscriber, if you're not a subscriber, it doesn't really matter. You can get access to a bunch of different, research that we provide. So certainly, take advantage of that. I know that's what, I was back in March of 2020. I took Hedgeye up on a free macro show, and that turned into 30-day free trial of a few different products. And here I am a little over 2.5 years later, and I am in-house talking to all of you in Hedgeye Nation. So let's get the conversation rolling. Or I'll just, I guess, ask my own questions. But I don't have a Jonesy Buds to help me out with some banter. What else we seen? All right, well, I'll wait for you guys to jump up. Let me keep going through some signals here. We haven't really talked about Asia. So one of the call-outs would be the Nikkei and India. Both continue to look really good. Nikkei in particular is putting in higher lows and higher highs. All right, weeks is coming. Oh, sorry. So Nikkei is putting in higher lows, higher highs. India continues to look really good. The DAX, interestingly enough, put in a higher low and a higher day. I know that's not Asia, and I kind of pivoted here, but just sort of international equities. But Asia in particular, Keith in his long-only count added UAE. I think that was this morning, and that so kind of like energy exposure. We do still have components like Vietnam, but we're really kind of sticking more to the two big ones would be like India and Japan. Hey, John, how are you, bud?
Hey, buddy. It's good to see you last week.
Oh, yeah, man. What a pleasure.
Yeah, it was nice. Hey, real quick, talking to some people last week, you were talking about the Z-scores. I think it's on the expanded version of Hedgeye University or somewhere in one of your user guides.
Yep.
But a lot of people have trouble with equating Z-scores and the lower and higher end of the risk range with regards to lower and higher volatility when Keith does what. If you could go over that or provide where to find it, I think that would help a lot of people, especially new people, because it's so easy to get lost in, well, if it's the top end of the risk range and it's a short, but where's volatility supposed to be? It just gets real confusing for people. Yeah, I'll shut up and listen.
No, weeks. No, don't. Yeah, that's great, man. No, let's keep that. But yeah, good, really good comment, and I appreciate you raising that to my attention. So I'm just going to say this. I can say this many times, but on the Hedgeye YouTube page, there are a number of what we dubbed a beginner's guide, but they're really kind of just deep dives, answering questions from subscribers and clients, of Hedgeye's various components, right? So everything from some macro stuff to product, how to leverage a product, how to work on your process, how to risk manage your kind of portfolio. So the eyeball table, I believe, is under the learning the process playlist. But I did like 22 episodes and answered like 3 to 5 questions in each episode. So there's but we basically clipped all those questions out. So I want to say there's at least 2 and maybe even 4 or 5 on eyeball, because you're right, John. It is a common question and one that we get a lot. So I typically answer the question with the eyeball table is just one other tool in the toolbox, just like just like knowing what your US dollar correlation looks like, just exactly like knowing what volume did on the everyday basis, what did price do on the everyday basis. These things are all volatility. These are all kind of tools in the toolbox. Where's the GEX, the gamma flip, right? Where's the GEX flip line turned from positive to negative gamma? These things are all, just tools in the toolbox. So the eyeball itself, and this is where, kind of looking at the trailing 12-month Z-score gives you a good idea as to like kind of what is been, quote, quote, normal over the last, 12 months. And anything that's like an outsized, kind of move, aka, call it two times on either plus or minus, that's something to be noting down, because it's an unusual activity. It's an outsized move. And typically, so what you kind of, again, I'll just talk about kind of like in a perfect world. In a perfect world, you want, we'll use USO as an example because it's got a plus 70 I-Volt premium, which is a plus 3.1 times, trailing 12 months Z-score. So it's it's big, to have a plus 70% I-Volt premium is like a big move over the last 12 months. If you had oil, so CL, or crude, however you want to track it, at the low end of the risk range, and you had that big I-Volt premium, that would be kind of a double whammy in terms of, what Keith would say is like, it gives you extra ammo to go bigger, right? Right now we have an I-Vol premium, but we're not quite at the low end of the risk range. Well, not in USO. In UGA we are. And so, he chose to go to UGA versus USO. I think probably because UGA is actually at the lower risk range. USO isn't quite there yet. But that's kind of like the combo you want to see. If you've got, let's do the same thing. So you've got a bullish trend, aka oil, and it's at the top of the risk range with the I-Vol discount. Even though it's bullish trend, it's at the top of the range. An I-Vol discount means that there's kind of, not, people aren't seeking protection, right? So there's like basically some complacency. Think about it as like complacency is setting in, and therefore, the premium builds up because your people buying kind of protection, right? So, so if you got like a discount, basically there's complacency there. So, selling into that, it's kind of like another little indicator of a good potential good opportunity to kind of sell into it. So not only are you at the top of the risk range or close to it, but you also got an I-Vol discount. And therefore it's, again, as I said, you kind of like execute, and depending on how big that I-Vol discount is, can help you decide in terms of like how big, whether you sell 25 basis points or say 100 basis points of capital. So that's kind of how you can think about it. That's why I called it out on Google. It's a plus 2.1 times on a Z-score basis. It's bullish trend. Andrew Freeman likes Google. That's a good setup. It's premium, it's an I-Vol premium. I don't know where Google closed though, so I don't know if it's at the low end of the risk range. Let me double check. Google closed at 133.74, and the low end of the risk range was at 134. So that is the textbook in terms of what you want to see. Now, did VX Goog close? See, now I'm doing this on the fly. Weeks, look at that. VX Goog did spike, so that's like the CBOE for volatility for Google. It did jump like over 6.5%, but we're still at kind of sub 28. So on the last year, this has been a pretty low level. So, that's probably the one knock on the Google side is that, you are at the low risk range, it's in a bullish trend. It has an I-Vol premium built up on it, but volatility did increase, right? So the other thing too is you want to look at volume. How much volume did that Google? So again, doing this live. So volume.
Thanks, because I couldn't find where to show it to somebody. I looked everywhere except on YouTube. So that
so volume was up today. Yeah, volume on Google is up like 118%. So that's kind of, so like Google was down on volume with increasing volatility. That's not a great setup, but so you maybe not one that you want to jump on right today, but kind of see where it sits tomorrow, the next day. And if that I-Vol premium continues to maintain or build, and you're at the low end of the risk range on the kind of decreasing volume and maybe flattening volatility, that could be a good one to kind of add to the books. But yeah, John, no problem, man. We're trying to do our best. So John, just so you know, we're trying to do our best to kind of put things on the website or inside the education center, whether it be Hedgeye University or Hedgeye. I think there's a new kind of site. I think it's called like Hedgeye Education or something like that. But basically putting it in the Hedgeye U area, as well as on YouTube. And then we're also posting a lot of them. Certainly the full length episodes were posted to Spotify and Spotify and Apple Podcasts. So we're trying to make it really easy for folks to kind of try to find them, certainly to consume them, and to try to help with the process.
Yeah, and that's where I think, people with regular jobs, and you guys have referred to this, some that can't be there for every trade. they're trying to figure out how to evaluate and act on when they can be there, when they have something actionable, and it can get real confusing for them. So
yeah, John, I don't know how you think about it, but certainly, I think one good, yet as something's transitioning or shifting from a phase transitioning from a bullish to bearish or bearish to bullish, those are the ones that you really want to kind of pick up on, right? So whether it be a Netflix or Google or NXLK or whatever it is, dollar, the treasuries, those are typically something. So like when you see kind of like a trend phase transition, those often have kind of like legs and time behind it, right? So, so that's kind of, again, I mean, it requires patience because those don't happen all the time, John, as you know. And but when you do see them building, or you see some of those lower highs or lower lows or higher lows and higher highs kind of starting to put in, even in something that's a bearish trend, you're like, okay, interesting. Does this, how does this sort of match up with kind of the signal, or sorry, the nowcast model or kind of our outlook, and then from there, as the signal starts to confirm it, and let's just say you've got, an eyeball premium starting to build, and even something that's a bearish trend, but then it moves to neutral, those are all positive signs, especially if it continues to put in kind of higher highs and higher lows. Again, those are kind of all positive signs, and if you're up on your up days and your up moves are on up volume with decreasing volatility, like that's all really good too. So I think that's probably for those that are trying to touch the portfolio less, being patient and being selective in terms of what you're seeing out there, and yeah, kind of like picking the spots.
Hey, yeah. Bob, can I ask? Hey, I know that you don't know the answer, but I've talked to several people, and I know they used to have a long only fund that kind of relied on key signals. But if or you think they'll ever get like a long short, either ETF or fund that basically mimics what Keith does in RTAs or in the Macro Pro subscriptions, for people that can actually put it in that and then not have to worry about the day-to-day stuff?
Yeah, great question. We're not there yet. I don't know. We're kind of we've batting out around some ideas internally that I really aren't at the liberty to kind of share at the moment, but we are coming out with sort of more of a dubbed it kind of like a portfolio solutions kind of product, which is really basically Keith's long only account and sort of the ranked positions and the historical positions and that kind of stuff, so that people can, again, to your point, John, if you're not kind of in the seat bolted to the chair, you can you kind of make these moves on say like a weekly basis or what have you, and kind of follow along, right? So I think that's sort of our first stab at it. Now those that have Macro Pro will kind of know that as like the re-rank inside of the morning shift, but we're kind of we're going to pull that out and really deliver something that's a bit more robust and that kind of thing. So depending on, even if you come into the movie kind of halfway through, you'll know that, okay, like, the dollar's moved from, if it was a couple months ago, it moved from the first, second ranked position behind FDRXX, down to the middle of the pack or, the bottom of the pack. Right. And so, similar to gold, right? Like where if you look at the macro themes deck, gold's a top theme, but at the same time, currently in the movie, it's at a minimum size position. So I think it's going to kind of help with that kind of stuff, which is a good thing.
Well, I tell you, buddy, I'll shut it up and try not to fall off the roof. But Macro Pro has taught me so much, and it's hours of information. Sometimes I get a little blurry-eyed. It has really been worth, at least for me, every penny.
That's awesome to hear, bud. I appreciate that, and I know you shared that with me last week. So, it's great to hear. I'm glad I can help out, and always here to help, buddy.
I'll see you soon, man. Yeah, man. And I'll mute myself.
Michael, welcome, my friend. You might be on mute, Michael. Oh, there you go.
Oh yeah, I'm on mute, Robert.
Hey, it's okay.
Yeah, how are you doing? Yeah, thanks, guys. Yeah, no, a longtime follower here, and appreciate all the work you guys do. But if maybe you guys addressed this in the beginning of the call, and if you did, just please tell me, and I'll when the call's over, go back and listen to it. But I just had a process question on managing the real time, in particular when you see today, when you see the indexes get to the bottom of their risk ranges, and you look at your longs, particularly off the top of my head, I think one of them's NYT, New York Times, and then you see Coach covering some shorts. Is from a process standpoint, do you look at that and maybe that's a time to add to it, or is that safe to infer? I know you guys were touching on Google about obviously looking at volatility and volume and really not having those tools in front of me, just very kind of 30,000 foot view. When you kind of see that action, how would you approach that?
Yeah, that's a great question, Michael. And the short answer is yes, right? So like a buy cover is a buy signal, it's a buy signal, right? So like if you see some things that you like or that are in your portfolio and they're kind of down near their low in the risk range or at kind of like a spot where you, again, even if you don't have the risk, whatever you use to help gauge you, right? Augment your process. If it's sort of lining up and you're like, okay, Keith's kind of, buying, covering some here. Looks like, again, New York Times is kind of at the low risk range or kind of like, it's down on the kind of light volume. And today it actually was down on, it was down on 80% of volume versus kind of the 5-day ABT. So, that was kind of a big down move on relatively light volume. And yeah, so again, yes. So the short answer is yes. I think the other thing too is, if you see the opposite of it, Michael, in terms of, okay, Keith's coming in, let's just say hypothetically the market did the opposite of what it did today, right? So it actually, moved higher and kind of like it sort of fed on itself to the upside, and you saw Keith come in and he shorted stuff this afternoon, but he really came in and started, shorting stuff and selling some of his longs. That's like one of these things where it's okay, like maybe he's not selling your long, right? Or that the long that's in your book. But he's selling other he's selling other things, and he's, hitting the sell button, the sell short button on other components that in areas that we don't like or that we think, have more downside risk. So you can kind of infer the same thing on that side too.
Right. Yeah. That okay. Great. Yeah. That's what I was kind of and that's what I was thinking as well.
Yeah. And
it's interesting where we are though, right on the spot. So we'll see tomorrow.
Yeah. No, exactly, Michael.
But
like similar to like on the long side, right? Like he added UGA, which is like gasoline, and then if you have,
yes.
Again, I don't know what you have in there, and I get that Macro Pro is for your product, so I get that. But in the he added, I'm almost positive he added, and I was traveling today, so I typically write down what the re-rank. But yeah, he added UAE, which is United Arab Emirates, at his minimum, and he was buying both UGA and USO today in that re-rank, right? So, you saw him add UGA in RTAs, he's adding it in like his long only count, he added another energy exposure, kind of like an energy related exposure. So again, that inference there is, okay, he's this kind of pullback in crude oil or in oil and to kind of enter the energy complex. He's looking at it as like an opportunity, an opportunity to get to gross up some of that energy exposure or kind of inflationary asset exposure. I should say energy specifically, but especially kind of like inflationary assets, the general bucket. You're on mute again, buddy. I don't know if you're talking.
Oh, I'm on mute again. Yes, I apologize. Yeah, no, it's just, I do. Yeah, fantastic. Well, that's great to hear. Thank you for responding and answering that question.
Does that
quick,
Does that make sense though, Michael? Yeah.
It does. And that's what I have been doing.
Okay.
And, it's just in those positions, like the way the panic, it felt like a lot of panic today, and maybe that was more positioning. That's why. And so, we'll see tomorrow, I guess, but it's interesting. And then with Tier 1 Alpha, how we ended right at the lower bands of their lower bands and right at the end of Keith's signal. So, it's I don't know if you talked about it in the beginning, but, is that an area where you could expect a bounce, or is this like downside pressure maybe can continue on?
Yeah, great question.
I mean, no one has a crystal ball.
No,
but
exactly.
just from looking at the segments. Yeah.
So we'll most likely, again, I'm almost positive, given just where the GEX flip was today, I don't think it'll move down, from 44.89 all the way down to like 44.10 or like 4400. But so almost positive we'll maintain in like negative gamma territory, which really means that kind of the kind of price action can sort of move more dramatically, let's call it, or kind of like have more volatility, a higher volatile environment, both to the upside and the downside, Michael. So even if we do get some positive move tomorrow, that like basically that downside pressure and the downside action you got kind of in the last 30 minutes was sort of just kind of like fed upon itself, right? And you could see similar to the upside tomorrow, and again, and no one, to use Keith's kind of terminology, he likes to do it more so to when the S&P, for instance, is accused or at the top of the risk range, and I think everybody knows should not be surprised about a 10% move to the downside or there's 20 to 1 downside risk, and that is obviously true, but now conversely, you could think about it the opposite way, Michael, in terms of, well, you're at the low end of the risk range depending where it is tomorrow. So you kind of have this environment where you could have, 5% ups or whatever, maybe not 5%, but 3% upside. Well, let me just, where is it right now? So I mean, bouncing from the low end of the risk range, you shouldn't be surprised if that happens, basically. But at the same time, no, is that always the case? Not at all. And this is where Keith often will say something that I've taken from him is oversold conditions. You can get more oversold from oversold conditions, right? So like basically selling can beget selling. So you could see some extra pressure tomorrow, and that same negative gamma environment, it just kind of can continue to feed on itself to the downside. And as I said, it can do the same thing to the upside. So it will be interesting. I mean, that price action, though, picked up a lot of momentum to the downside in the afternoon. So it will certainly, I think it's more of, what will the market kind of, again, just depends on your time horizon. I think right now, the setup, as I've kind of been alluding to in terms of the lower lows and lower highs, I think like the longer term right now, it's certainly looking like this sort of is a bit of the beginning of this, again, like the bearish kind of trend. It's been a little back and forth the last, call it, week or so. Kind of had a down move in August, kind of like then a little bit of a bounce in September type thing. So it's kind of you've been seeing some a lot of lower highs, and certainly more recent cycle lower highs as well. And so you could kind of see this. Seems to me like it's a bit more of things could pick up to the downside here. Don't forget, quarter ends in like 2 weeks, not even less than that. And you've got so be conscientious, right? You've got quarterly options expiring next Friday, so the 29th. So we've got not even 2 weeks. We've got 7 days. So and you got quarterly options expiring. That's you're going to see it all over Twitter and FinTwit about the JP Morgan caller that they put on. Again, these are just talking.
Oh yeah,
these are just talking points, guys. Right. So these are all just things to be conscientious about. They're not necessarily any one thing that you need to act on and you need to be overly concerned about, et cetera, et cetera. But like be conscientious of like where are those collars put? And I believe they typically go 20%. I think I believe it's 20% to the upside and to like kind of like to the downside in terms of like their protection, if memory serves. It might not be quite that much, but I believe that's what it is. So again, you could see a little bit of squirrely price action, kind of the next sort of 5 to 7 days as dealers reset their books, as some big shops reset their kind of hedges and books, et cetera, et cetera. But then you've got, earnings shortly thereafter. The quarter ends and you'll get that earnings season will start to begin and typically kind of late October, late-ish October going into early November timeframe. So just be conscientious because again, we do talk a lot about like what's happening today and this week, but really wanting to be conscientious as to what's coming down the pipe next week, next month, et cetera, et cetera.
Great. Yeah. Fantastic. Thank you.
Yeah, you got it. What?
Talking that through.
Yeah, totally.
Yeah.
Totally. So what, out of curiosity, what so obviously you have RTAs, but what do you subscribe to anything else?
Oh, great question. Yeah. I think I do the tier 1, the RTAs, and the macro show.
Awesome, man.
Yeah.
That's a good comment.
And of course the call is the greatest product. And I love that.
Yeah, there's a lot of great minds in this call. There's a lot of great minds in that call. That's great, Michael.
Yeah.
Glad to hear that.
No, I remember a guy. Yeah, I've been following since 2009 or 19.
Okay,
sorry.
2019. Okay, cool. Yeah. Awesome, buddy.
But yeah. Yes. Well, thanks for your time. Great to. No, that was it. Just a quick personal thing. I actually added to NYT and the LLY today. So, but I'm nervous about it. But you shouldn't be nervous about your positioning. Obviously, that means you're too big. It just anytime you see these big down moves, you're like, I don't want to add. And you definitely you want to you just you whip around like that and you want to press it. But we'll see.
Yeah.
So.
Yeah. Eli Lilly. Yeah, Lilly. The guys that Keith and Mike T talked about that one yesterday.
Yes,
right?
yes.
On their great real conversation. So you haven't watched that webcast is again free for anybody, and it was a really good conversation. I think Keith's commentary there.
That was great.
I don't know how long if you've been long of Eli Lilly before, but his commentary before was basically I think there are only 2 healthcare ETFs that really. We're standing out in terms of maintaining, relative signal strength, and it was Pink, which is long Eli Lilly, and then some other ETF that basically held like 20% of it or something, a big time holding. So that's kind of been it's been a good winner inside of the healthcare space, considering XOV is bearish trend, and there's a lot of components in there that are definitely underperforming. Yeah.
Yes. Yeah. It is interesting. So.
Oh, good.
Well, great.
Well,
I could talk more, but I actually got to run. I got to take care of some dinner for
no
the
problem, man. No,
I'm pretty.
Welcome to the family.
No, it is.
It's great. Great to hear a new voice.
Yeah, it is. I've been a long follower of you guys. What are they saying?
Long time listener.
An FDR first. Yeah.
Exactly. Yeah. Enjoy dinner with the family, man. I appreciate your time and thanks for jumping on.
Thank you all.
Absolutely. Yep. All right. Well, we covered a lot. I mean, if anybody else got any questions out there, by all means, jump right on up. I got a few more minutes here. You can chat for a bit longer, but we can also just kind of wrap it up. Spend an hour. It was a big, long travel day today, Weeksy. Another long one. Not quite as long as last Wednesday, but going into Thursday night from Vegas. That was very, very unfortunate. But just anyway, what else? What did I miss? Did I miss something? We haven't talked FX, but we don't have our boy Thousand Air FX on here. But I will say, I think kind of one of the interesting things, and we mentioned this, I think 2 weeks ago on the Canadian dollar versus USD, and how it might have been 3 weeks ago, but not surprising, but just sort of it was maintaining, it was bearish trend. It's now moved back to neutral. It's now moved to neutral. So that's something kind of to be paying attention to in regards to the Canadian dollar. The pound is bearish, and the euro continues to be bearish. So kind of the rest of that general kind of FX complex hasn't really changed much. Keith added to a European short today, and I think that's again, not that I don't want to be like it's easier hunting ground, but certainly the European recessionary environment appears to be a lot closer to the forefront, perhaps than maybe here in the U.S. But so just kind of those European shorts. Watch the cross though, the Euro USD cross. It does impact the the euro ETFs, right? So just be conscientious, kind of look at both, whether or not the pricing or the indices that you're shorting in Europe are making higher highs, higher lows, lower lows, lower highs, and then obviously cross-reference that with the FX cross as well, because it will kind of either help you to the downside if say the euro is continues to weaken against the US dollar, but it can also kind of can hurt as well. So the indice might be going down, but the euro is going up, so not quite as won't be quite as profitable as you might wish. The other weeks you mentioned kind of, or in our conversation we talked about trying to catch things that are phase transitioning, and silver certainly was one that was, so kind of things that are losing strength, just as an FYI, because people sometimes ask me like what goes in my notebook, and things that are losing strength I actually put a little square around, and things that are gaining strength I circle. Typically it looks more like an oval, but again, just a little fun fact. So silver got a square, and it's losing strength. It's currently neutral on the page, but it did put in a lower low and a lower high on a day-over-day basis today. And I think you should be kind of tracking that one pretty closely. Like if it it may pick up strength. It does kind of often trade in step, a little bit of a laggard versus gold and kind of general precious metals. But if that doesn't, or if that kind of continues to confirm some weakness to the downside, and perhaps even changes to a bearish trend component, and continues to put in a lower low and a lower high, that's certainly something that is worthy of calling out and noting. The other component too, which also has a neutral tag on it, would be copper. So I kind of track it through both copper and the risk range, and DBB is an ETF out there. So that would be Weeks, you're gonna kill me. I forget what D is. I'll just say David. I know that's wrong, but we'll go with David Bravo Bravo. And so David Bravo Bravo is the base metals ETF. It's sort of picking up. Oh, you're coming back up. Great. All right. What's D, John? What? Delta. I knew it.
One of these days, I'm going to teach all you.
I knew it though, John. I knew it. I was like, I knew it's not. I knew it.
More you're being a submariner and me being an aviator, one of these days we're going to get you to learn the phonetic alphabet.
I know. So here's the problem: is that like my little printout sheet is at home, and I'm in a right? So I don't have my cheat sheet in front of me. But yes, Delta Bravo Bravo. The point is, Delta Bravo Bravo is it's kind of picking up some signal strength. Now it's more of a basket, but you've also seen copper kind of turn from bearish to neutral over the last few weeks. So that could, again, these inflationary assets, John, as you know, they can kind of start to permeate across the board. It starts in energy and might rotate over into some other components like ag, or another good kind of broader basket ETF, for ag exposure is DBA. So that would be Delta Bravo Alpha.
Very good. Bravo's in, Bob. Bravo's in.
There we go. Did you hear that was a question mark though on Alpha? Hey, did you hear that? That was Alpha. So anyway, DBA.
And I don't know if you're watching tonight, but you may get a chance at gold tomorrow. December gold's down 1.12 at 1945 right now, and the futures have been down all night since the open.
All right. So that's so just kind of keep an eye on the inflationary assets across the board. I think that's probably a good way to kind of end it here. John, you got any other questions or commentary, buddy?
Nobody. I hope I was trying to help you with some airtime, but I'm glad you made it home.
Yeah,
you ought to make a horror movie about your flight back to the East Coast last week. But
it was rough.
I'll leave it at that, and you take care of yourself.
All right, buddy. You too. Have a good one. Everybody at home, hope you're well, and we will see you next week. I think we're going to do kind of a midday show next Wednesday. I'll just kind of depend a little bit on travel. No, I'll be here. Yeah. So I'll probably do kind of a midday, maybe a lunchtime East Coast notebook review next Wednesday. So keep an eye out. I'll make that announcement. I give everybody a little bit more of a heads up. Apologies for the delay today. I just kind of want to make sure that travel, all that kind of stuff. Didn't know what my schedule was going to look like, but Hope everyone's well. Look forward to catching up next week. And then, and anybody, as I mentioned, anybody in kind of the Charlotte, North Carolina / South Carolina area, look forward to seeing you guys 2 weeks from now on October 4th. With that, I'll bid you adieu. Thanks, guys. And gals, I see you out there, Laura.
Don't forget to check out Hedgeye.com to get more actionable investing insights from our team of more than 40 research analysts. And check us out on Twitter at our handle, @Hedgeye. This presentation is informational only. None of the information contained herein constitutes an offer to sell or a solicitation of an offer to buy any security or investment vehicle, nor does it constitute investment recommendation or legal, tax, accounting, or investment advice by Hedgeye or any of its employees, officers, agents, or guests. This information is presented without regard for individual investment preferences or risk parameters and is general, non-tailored, non-specific information. This content is based on information from sources believed to be reliable. Hedgeye is not responsible for errors, inaccuracies, or omissions of information. The opinions and conclusions contained in this report are those of the individual expressing those opinions and conclusions and are intended solely for the use of Hedgeye subscribers and the authorized recipients of the content. All investments entail a certain degree of risk, and financial instrument prices can fluctuate based on several factors, including those not considered in the preparation of the content. Consult your financial professional before investing. The information contained herein is protected by United States and foreign copyright laws and is intended solely for the use of its authorized recipient. Access must be provided directly by Hedgeye. Redistribution or republication is strictly prohibited. For more detail, please refer to the terms of service at hedgeye.com/terms of service.